Hans today is announcing a new fintech fund.
Perfect.
So for any entrepreneurs out there, you want to hit them up after after we talk. So it's called Nika Partners. Why don't you talk a little bit about why we need another fintech fund right now?
Okay. Well, there's a lot of great investors here, so I don't think that there's necessarily. I think all the people you've heard in this panel and some of the other panels have had great returns and done a great job. But what I saw at General Atlantic was that the financial services industry is unique in the type of investments that are successful. And why is that? And I think, first of all, it's complicated, super complicated. And second, it's heavily regulated, often requires funding, often requires connections to existing networks which have their own requirements. And those requirements often are very difficult for new companies to meet. So if you say what's the experience, even though there's some great experiences that were talked about, like for example the last panel, most of these deals fail and never get beyond 5 or 10 million of revenue. And I saw this quite frequently. And I felt we could help, and the firm's called Nika. With a reason, it's a contraction in New York, California. I live in New York and San Francisco, and I think that perspective is actually quite helpful because when I'm in California, I think, wow, that's incredible. All these problems can be solved, and you get all this incredible positive energy. And you come back to New York and you say, God, what was I thinking when I was out there? It's crazy. That will never work. And so I think that the team that we have and our focus on just a couple of areas of financial technology, we can help navigate the very complex problems at the beginning, get people on successful footing, and help using our experience really of over 30 years in financial services to really work.
So how does your background? So obviously a lot of VCs come out of tech, and you come out of the financial industry. In fact, you were Citigroup for 27 years, and then you were president of Visa. So how does that inform what you're doing and differentiate you? So
I had I think, a very interesting career because I spent, of my 27 years at Citigroup, 20 of it was as an investment banker, and 12 of those I was head of the FIG group. And we did a lot of we didn't call it fintech then, but I was a banker to First Data for many years. We did most of the M&A of all the ATM networks. We did the privatization of NASDAQ, as MasterCard's banker, IPO of PayPal. So I worked on a lot of companies, and my organizing principle for all that, starting in the late 80s, was, you know what? Financial services companies are information intermediaries. That's what they do. That's where the margin comes from. If you're lending money or trading bonds or insuring a policy, you have to have some competitive advantage of information or there's no margin. But information costs, even 20 years ago, were declining rapidly, disrupting that margin. So it caused a shift in the business. It takes on like an ATM network, which had zero margin in it, suddenly had a lot of margin in it because it was a service that then became more important than the margin that was in like the deposit account. So with that as an idea, that drove a lot of our thinking for a long time. I worked with many, many, many companies, again, 20, 25 years ago. I then went 7 years at Citigroup into management. So I was chief operating officer of the investment bank, and I was the CFO for the institutional businesses. And I was, for 4 of those years, I was head of ops and tech in addition to finance. So I saw the complexity that you're sitting on in a way that I had no idea when I was an investment banker. And I would say, honestly, that's also true with a lot of VCs. Like they don't know the guts of how some of these things really work. So you can take an idea and you say, that sounds great, go do it. And then you can say, wow, that's just not going to work. That will never get done. That will never meet the requirements of that network. That will never be funded. That could never, for Citigroup or Goldman Sachs or somebody else, the idea is we're going to sell this product to big institutions. I know, I was the buyer of that product, and it would take 4 years to make a decision sometimes. And something we really wanted to do, we just couldn't do it, even if we wanted to, because it wasn't budget or it didn't meet our compliance requirements or something else. So all that complexity, where there's some disaster, believe me, some disaster happening every day in that job, I lived it in a real, intense way. At Visa, same thing. I lived through the choices that we were making, how we made money, how how resilient some of our moats were, how difficult it was to get scale in a network, but also what some of the real things we couldn't do. We just couldn't figure out a way to do it. And what I find interesting since I left Visa is meeting all these entrepreneurs with, in some cases, just brilliant ideas of solving problems for which there is no existing solution. That's inspiring, and that's what I think we can help. So I can tell the difference. I can help someone navigate between that's a problem, but is never going to get anywhere, versus that's a problem that for which there's no solution, and that's going to be a fantastic winner.
So for the entrepreneur, well, I guess for the VCs as well, I mean, what sorts of, what areas specifically are you going to be focusing on, and
so,
about, what, like series, stage investment?
So we're, our fund is going to be small, and it will be, we'll have some partners that we're not ready to announce yet, but I think in aggregate, we're going to be investing our money, and each of the people who's a partner also has a really great operating track record. And I think we'll be investing, I would say, $10 to $15 million a year or so. And what we're investing is our time as well as our money. So that mix changes. So as a later stage company, like Lending Club is one where I'm a director, and I didn't put any money into it, but I'm investing a lot of time in it, and I've been compensated through equity. So we look at that as equal. We can do later stage things where most of our capital is not driving the business decisions, but where we can help. Or we've done some earlier stage companies like Affirm, for example, or a company that was just acquired yesterday by Global Analytics called Work Pays Me, where we invested both money as well as time. And so that's an essential part of the firm, that we're doing both. So we will do some very early stage things, and we'll do some later stage, like a year before an IPO type of, or a couple of years before an IPO type of investments. Really just three areas we're focused on. And to me, and there's lots of areas that we've talked about today in financial technology, but three that I think are most interesting to me. So one is what I call merchant solutions and payments. Merchants have a very difficult life, solve their problems. I think that's much more better way of thinking about the best opportunities in payments than some of the other schemes that we could also talk about. The second area is alternative credit, and that includes both networks and design for credit delivery, or new data sets to help make better credit decisions. And the third is infrastructure around settlements, and I would describe it as infrastructure where there's going to be a lot of change and the world isn't ready. The financial services companies aren't ready for that change. So mortgage technology is a great example. I think cross-border settlements are a good example. And I think data implications for benchmarking and for analysis of capital markets investing is another good example. So those three areas.
And just so you know, so I'd like this to be interactive. If you have questions, although I can't really see you out there, just raise your hand at any point and jump in. We were talking earlier about how you evaluate fintech startups and how you have a different perspective than say a traditional VC. So can you talk a little bit about that? I mean, we're talking about on the credit side, for instance.
So let me give you two examples. So one is credit, and I have 4 rules for credit. People here might disagree with these, but I've been involved in credit for 30 years, and my first rule is the product you're offering fair and transparent and in the interest of the borrower? Because a lot of models for decades have been built on, I would say, tricking that customer into a profitable relationship. And in my experiences, that can be really successful for a while, but it always blows up, always. So that's rule 1. Second rule is, do you have a competitive advantage of information in underwriting, and is that sustainable? So if you're using FICO scores, that's available to everybody. There's no real competitive advantage. There's nothing different about the data you have or the way you're applying it that gives you something that's sustainable. And the third is, do you have a competitive advantage of origination? And if you're acquiring names on the internet or something and there's nothing really special about it, that's not sustainable. And the fourth, which is often the killer, is can you eliminate funding risk? Because every 4 or 5 years, if you say we're going to fund this in the wholesale markets, my view is, well, every once in a while that blows up your company. And we could go through dozens and dozens of examples of that. So if you say those 4 rules, how many companies meet all 4 rules? I'd say there's many business models we look at where they fail all 4 tests. They don't meet any of the 4 tests. So I think it's a very hard set of tests. And I think Lending Club is a good example. I thought that was a great model. And I thought they had, it's a network, so there's no funding risk. They had demonstrated, I think, really good capability in terms of adding value in their analysis of the loans. Is very fair, very transparent. So that's a good example. But there's plenty of other examples. I thought that many. I mean, I probably looked at 80 or 100 different models around credit. There's only a few that I found really, really attractive. Another one on payments. People come in all the time and say, "Here's something. This is a really good. This is better than what you have now." And I think in payments, one of my rules is being better is inadequate. You have to solve a problem for which there's no solution, because in payments, like right now, you just think about it, you have to deliver a product. If you're doing something which is, acceptance and settlement, which is what Visa and MasterCard do, you do that right now. The merchant wants to do a debit transaction where the cost is 22 cents plus 5 basis points. So 22 cents, you have to deliver ubiquity, has to work 100% of the time, like 6 or 7, the Visa has never been down since VisaNet was installed. So the merchants count on that. And you don't have any training costs, you don't have to change your infrastructure. So to compete with that, to disrupt the line, McDonald's told me that 1 second on the line in the United States cost them about $1.3 million across the United States. So in other words, when someone has to say it's not working and we need the manager to come over, that's a big problem for any retailer. And retailers have, on average, 300% turnover of point-of-sale personnel. So, and then the last thing, this is actually newer, which is data risk is a board of directors issue at every merchant. So some new startup which says we're delivering this new thing at the point of sale, the board is saying, we're not doing anything new at the point of sale if there's any risk of data. And how do we know? You say, well, we got these 4 kids with their dog here from Stanford or whatever, and they really have a great idea. It's just the table stakes are so high. And so I think that really almost all those ideas are going to fail. And some people are then saying, okay, we'll throw in data. We'll help the merchants sell the goods. And the reality is that if you say, all right, we could put together a fantastic video of Trisha's example of walking with her daughter and getting the Bluetooth sensor, which is telling her that something's for sale. But most of those schemes rely on the merchant paying for it, right? The merchant's going to pay you to sell more goods and services. And if you go, any merchant, and I've spent years on this issue and talked to a lot of merchants, and you say, where are you getting traction on that? Where's that really working? Where is data giving you new customer acquisition or new insight into buying patterns that are really driving your business? Answer is 0 at this point. Now, they're interested in exploring it, and I think it might work, but it's a really hard thing to do. You have to have really great data that's highly relevant. And knowing that Larry goes to CVS, he bought gas, he went to to Walmart, he then bought coffee, but today he's going to buy a gas grill, and we know that. We're going to incent him, and when is that spam, and when is that really useful? Looking at a lot of companies, I can tell you it's not much, and the merchants aren't paying for it, and so there's no margin in those companies right now. So I think a lot of that's going to end badly too.
So I need to go on record that I do not shop at Walmart. We have a question over here, sir.
Just going back to the points you were making on credit.
Yeah.
Particularly sort of on the consumer credit side and talking about proprietary mechanisms for assessing credit risk. I'd be interested in your perspective on some of the sort of emerging business models looking at sort of expanding, consumer credit rating and those companies that are sort of looking to upend TransUnion and tier.
Yeah. Well, I think that's quite interesting, actually. And I think that the way I break it down is if you take the United States consumer population and you say there's about 120 million households, and you say how many of those are investment grade and decisionable, and it's about 40% of the households. Okay, so that's where all the banks Amex, everyone focus. And then you got about another 25% to 30% of the households who basically, you really can't lend money to them because they don't have jobs, there's too much disruption, there's no data, so that's hard. And those people, good percentage of people just will not pay you back. It doesn't matter how much you know about them, they don't pay you back. But that still leaves you a nice band of about 30 or 35 million households where, FICO doesn't tell you, it doesn't, saying that a 600 versus a 590, which of those can we get more insight and who will pay us back? Those people don't have access to credit. I mean, you had 11 million mortgages, 20% of the entire homeowning population was seriously delinquent. They have bad FICO scores. They don't get access to credit. Well, that's a lot of people who were, doctors that, my brother's an architect and he filed for bankruptcy and he's a partner in an architecture firm. He has no credit. And so being able to decide which of those are people who are going to pay you back and not, there's all this new data. It can be applied better. There's a lot of very interesting insight, I think, in terms of behavior shifting inside those cells. So it's a really good area to focus on.
So help me understand this. So is this, I've heard about some startups using basically social media to sort of create a score or something like that based on what their friends say about them or their trustworthiness. I mean, can you talk a little bit more about that?
It's a tricky area. If you go to a bureau, the bureau will say that this data, they will say, okay, we got our new score and we've tested 10,000 variables and we use 200 in the model. And they're also going to say all of this is compliance certified. That's a big fact. So if you say, well, you know what, it's really interesting because we're using social data to decide, help us make credit decisions, and you say, and we found out that Chinese people are better credit risks. That might be true, but that's not legal, right? So no bank is going to use that information to make a credit decision. And it's just like a lot of other things we talked about today. The regulatory framework is not necessarily where the data is. So what you're allowed to use, how you're allowed to use it, is a very quickly evolving area. And again, there's differences between what a bank will say they're allowed to use and someone else might think they're allowed to use. But ultimately, I will say, anyone that comes into us and they're using some of this data, I say, you're ultimately going to be in the same regulatory sphere as the bank. It's credit, and that will ultimately get regulated in the same way.
Got a question over here, this gentleman.
I'd like to ask about payment rails. I'm not going to ask a question on Bitcoin, although unfortunately Bitcoin might be the answer. But most of the payment rails are going on 40 years old. So whether you want to talk card associations, ACH, most of the new things on the market are interfaces. They're not really changing the rails. So clear exchange maybe, but there's still some ACH settlement behind the scenes. So I'm just curious, what are you seeing actually at the payment rail level, interbank? Do you see anything new happening there, and anything that might be viable?
Well, that's an excellent issue to talk about, because I think one thing I would say is the whole infrastructure of the global financial system is on average 40 years old. And you could say, oh, it's better, it's more resilient, we speeded it up, we've done other things, but generally you would never build it that way today. Like, for example, you would never build, Visa is a private network. It's really expensive, big, giant private network. Why wouldn't you just use the internet? You just use IP addresses rather than merchant accounts, and you could make it super secure. Good, no reason not to be, but that's not how it's built. And the problem is, when you have a network, it's not just the technology, but it's the rules around that network. And those rules are generally serve a useful purpose, and everyone relies upon them. So there's tons of infrastructure built up by everyone, which is reliable. You could do it much better, just like you could change the tax code and make it a lot better. But it's really hard to change the tax code, because as soon as you change one little thing, it hurts somebody else. So I think you don't need Bitcoin protocol to create a new network. You could create a new network today that would be so much better. But you can't get everyone to agree. So, and the ubiquity is table stakes. And so I would say, again, go back to my earlier message, anyone that tries to say, hey, this is better, 9 times out of 10, that's going to fail. Why, look, if you look at the really big successes, say PayPal, and I worked on an IPO of PayPal, and I was there at the beginning of it, and it was kind of a mess, right? But what made PayPal successful? They solved the fraud problem. They cleaned out, as I like to joke with Peter and Max, they cleaned out everyone who purported to be a pornographer and a gambler. Not necessarily everyone who was, but they got rid of all the stuff that at least purported to do that. But they solved the basic problem, which is if you were a small merchant, there was no way you could get a merchant account using Visa MasterCard rules. So you were sending checks, the early internet, and PayPal solved that problem. Created something significant. Once you have a couple million customers, there's lots of things you can do. But at the beginning, to get to scale, you need to solve a problem for which there's no solution. I would say Square did the same thing. Square went in and said, no way for a micro merchant to get a merchant account. They solved that problem. Very efficient onboarding, plus very, very good fraud control and risk controls around that. So solve a problem for which there's no solution, you can do something if you can scale it. If it's just better, I just think it's too many problems to overcome. So what's a big problem? Right now, international settlements are based upon a theory of it either meets certain rule sets and risk levels, in which case it happens, and it's not priced for risk though. So certain things which are very low risk, but they're below that level of which the assumption is, they could be done cheaper. Or if it's above that risk level, the transaction doesn't happen. So no one sells iPhones into Nigeria because it's too risky. So if you can solve that problem and create protocols, and actually I think Bitcoin protocol has very interesting things, it allows strangers to have a trusted, secure, 24/7 transaction, that's pretty powerful. But you need a rule set around that because, well, suppose they still rip you off. It doesn't say you're not getting ripped off. Suppose you never ship the iPhones or something else. So there's lots of other things that need to go with just that core technology. But so that part, I think there are some interesting ideas which will require some time to explore.
I think this gentleman had a question here.
So,
Yeah.
Going back to the previous topic of that kind of group of people who can't get credit scores, but they're probably good sources of payback. So do you think the Ripple protocol using its trust line and that concept of a P2P trust line, then building up a score internally inside that network, would then be a solution to bring those people back into the fold?
Yeah, I think that there's a lot. You know, what's a really powerful idea with this intersection of data and you know, these data sets, which and one of the big themes we've heard about a lot, but it's authentication, right? How can I authenticate who this person is and really observe that behavior over time in a lot of different circumstances? That's a really hard, you know, if you say, how does it work now? You know, it's not that different. You say, how do banks do it? It's a little bit better, but, you know, basically it's like out of pattern behavior. They say, well, you're probably not who you think, or device ID. But it can get a lot more sophisticated. And could you give, in effect, a contract with someone and allow them to improve it, like Credit Karma and some other things are doing, but could you take that at another stage? I think that's interesting. Which is great. And I think what I find the most interesting part of my job is, every week, John was saying this, every week someone comes in with some really interesting ideas, and some you think will never get to scale, but they're still really interesting ideas. And we're at this, part of the reason I started the firm is I think we're at a point now where a lot's coming together where things that wouldn't have worked 4 or 5 years ago, you can say, well, that actually has enough promise right now. It's really solving a very fundamental problem, and we can maybe work it into a regulatory scheme and solve other things so they could really work and become big.
We've got about 5 more minutes. Any other questions?
Yeah, Mark?
Follow-up question.
So the thesis for your new fund sounds similar to the thesis for the FinTech Innovation Act.
Yeah.
There was an identification by the major institutions that technology was going to the West Coast,
Mm-hmm.
and it was being developed outside of FinTech and then being brought back into the FinTech channel, but not purpose for that.
Mm-hmm.
So my question is, do you think that strategy going directly to the institutions is valuable, or do you think that the DNA of the institutions won't allow that innovation to really flourish? And would you work inside that construct or outside?
Yeah, I mean, I think that's a great question. I think, to be honest with you, I think one of the things that I hope to do is, I think me and my partners are the type of people who are trusted by some of those institutions. And I think that I know enough to say, even though when I was at Citigroup or Visa, I might say, that's a really good idea, and we want to get behind it. I also know the reality is you go back to a budget process, you go back to all these other priorities, and it doesn't happen, or it gets buried inside. You can't find the real application to make it work. What really happens, what you'll see in that FinTech lab is someone will come and say, hey, I got an AML issue, and sometimes we'll be like, I need a solution for this right now, and we don't care what the budget is, we're going to do it. It doesn't happen that often. I'd say also Visa, and I'd say this is a good rule. I don't know how many people here are entrepreneurs, but I'd say having a strategic investor be part of your fund is a double-edged sword. I think it works. Sometimes I would say, yep, that will really help. I think Visa's investment in Square was a great example of that. Gave them a lot of credibility, helped get that original card-not-present security issue resolved favorably. But it can be ruinous to a company. And I think a big company has a lot of hobbies and a lot of misdirection. It can just whipsaw around a little company and make it very unproductive and waste a lot of resources. So you got to be very careful. So I'd say the best strategy is be close, but keep arm's length sometimes from some big institutions and go your own path.
Any other questions?
One back there. In the...
Yeah, you alluded to capital markets infrastructure technology. Are you seeing things loosening up in terms of innovation in that space? It seems like the past 5 years that area is pretty much choked under the weight of collapse. Are you seeing more interesting things happening?
Well, that's also a very good point. I think that essentially a lot of the buying centers, if you're gonna sell to big institutions, that is a really long haul. That's a couple of years, often longer, to get something actually sold. So there's not that many companies that can tough it out long enough, have good enough product to survive. What I think sometimes, so therefore there's some really good models. They say sell to hedge funds or sell to the buy side where there's thousands of them. And at GA, we're Investor Risk Metrics, great example. Everyone needed to produce their Greeks. There was a wave of that. They were one of the best systems for doing it. Very easy sale, really good business model. So what I think is interesting is not like new front-to-back systems or things which are just awfully hard to bet on. But what I do think is I've seen a couple of great companies who are saying, you know what? Think about the way data is presented and analyzed right now. It comes in through basically 25 feeds that the prime or the underlying custodian has, but really you can benchmark anything to anything. And when you look at what investors really want, they want much more granular risk analysis and real alpha performance and analysis of that. How could we organize the data to do that? That's a really great idea. So I personally think that's exciting and a good example, something that could apply in hundreds and hundreds of buyers of that type of product.